Welcome back to Intelligent Investment Today, the podcast concerned about all things value investment. In each episode, we take a look at a different topic and attempt to apply the lessons taught by the man widely considered to be the father of the craft, Benjamin Graham. In this episode, we take a deep dive into an investment policy employed by many would-be investors. That is the strategy of market timing. We will discuss the theory behind it, how and indeed if it works in practice, and consider what Graham had to say about it. So without further deviation, hesitation or repetition, let's get right on with it. So as ever, sit back and get ready for another lesson in the art of value investment as prescribed by the man himself, Benjamin Graham. The strategy that we're going to be talking about today, known as market timing, relies upon the purchase or sale of stocks in an attempt to predict and profit from short-term market movements. A practitioner of the market timing strategy will use different forms of analysis that they believe will allow them to predict future economic conditions more accurately than the market as a whole. This prediction can be based on technical or fundamental analysis, or even a combination of both. Let's first consider how technical analysts use market timing to attempt to profit from market swings. This strategy looks to forecast future price levels through the study of past market data, looking primarily at historic price levels and the volume of shares bought and sold. The theory goes that the study of these past prices and volumes can highlight patterns or business cycles, which is hoped will be repeated into the future. A technical analyst believes that the current stock price reflects all available data, and as such are not in the business of trying to predict future economic developments or news events. Instead, they attempt to profit from price movements which they believe have a tendency to repeat themselves due to the collective pattern behaviour of investors as a whole. There are many different ways this can be carried out in practice, but all have in common this belief that investor behaviour is prone to repeat itself. Technical traders will typically target stocks with a clear upward trend of rising prices for acquisitions and those trending lower in order to short. Moving average charts that smooth out day-to-day price movements and give a more general direction of a stock's price will help them to find such stocks. Fundamental analysts wishing to partake in market timing, on the other hand, use techniques that will be much more familiar to the value investor. They will look to a business's financial statements to garner information related to assets, liabilities, and earnings, as well as look into the wider picture of how the industry and economy is performing as a whole. The main differential with value investment here is typically that they are likely to place a much higher degree of emphasis on the qualitative factors at play. Those factors such as the quality of the management team, the outlook for the industry, and the direction of the economy as a whole. All those things that are most open to opinion and interpretation. But where those employing this technique to time the market really differ from value investors is that their investment decisions are driven primarily by the movement of the market rather than to pick de facto bargains. Like those using technical analysis, fundamental analysts will be driven to buy or sell by what can often prove to be quite arbitrary market highs and lows. On the other hand, value investors care very little about the history of a business's stock price. If a business is discovered to be worth considerably more than its current stock price based on its financial history, and the qualitative outlook does not undermine this valuation, then that stock may be considered for purchase. Whether the stock is trading at all-time highs or lows should be completely irrelevant. So what can we say about the prospects for those wishing to practice the techniques we've described to time the markets? It seems obvious to me at least that technical analysis in all its forms is a pseudo-science. It is clear that a few do succeed at this endeavour, at least in the short term, but how much of this comes down to pure luck and what part is skill is up for debate. The law of averages alone say that not everyone can fail, not all the time at least. Whenever I think of technical analysis, I can't help but be reminded of one of my favourite episodes of The Simpsons, where Homer starts investing in pumpkins. He's impressed that he's seen their value rise in the whole month of October, and he's got a strong feeling they're going to peak in price right around January, and that's when he's going to cash in. And I'm convinced that the vast majority of those using technical methods to time the market are also likely only to be left with worthless, rotten pumpkins. The prospects for fundamental analysts taking part in market timing activities seems a lot more promising. The fact that they should at least be considering the quantitative financial picture leaves them in a stronger position than technical analysts. But unless they're very careful, their fortunes are likely to go astray. Too much focus on predicting what is essentially an unknowable future is likely to undo all their good work. They're likely to make the age-old mistake of the investor, that is, overestimating their ability to foretell the direction of a business, the industry, and the economy as a whole. Even if they can avoid this pitfall, trying to time the market and buy at the optimum time is likely to cause even more confusion and provoke errors. A stock selling at a much lower level than it has done previously can prove to be an overwhelming lure to investment. If a stock that is currently trading at $10 that just months previously was trading at $30, the assumption can often be that if it was worth $30 then, it must only be a matter of time before it recovers to these heights. The reality is that there is no guarantee that its previous valuation constituted anything other than unwarranted froth never to be repeated. Being driven by price fluctuations can therefore be considered a pernicious distraction. The conclusion of this edition of Intelligent Investment today can be pretty comprehensive. Trying to time the market, whether using technical or fundamental techniques, is a fool's errand. Technical analysis, in my opinion, is little more than a pseudo-science, where even those who get lucky will not stay lucky for long. And those applying the techniques of fundamental analysis in timing the market are seeing the conclusions of their honest work being lost in a sea of confusing, arbitrary and alluring market fluctuations. Fundamental analysts, even those wishing to try the luck at prophesizing future outlooks, will do better by ignoring whether they happen to be buying in a peak or a trough, or indeed looking for arbitrary directions of travel, and instead ask themselves, does the current market price offer them value versus what their analysis has uncovered? In Graham's book, The Intelligent Investor, he states, the one principle that applies to nearly all these technical approaches is that one should buy because a stock or the market has gone up, and one should sell because it has declined. This is the exact opposite of sound business sense everywhere else, and it is most unlikely that it can lead to lasting success on Wall Street. He then goes on to state that in his experience and observation, extending over 50 years, he had not known a single person who had consistently or lastingly made money in this way. It seems clear that value investors will do well to avoid either consciously or unconsciously being sucked into the rabbit hole of market timing. It can be tempting even for those with no intention to time the market to be sucked into this practice by considering price history in their calculations. As a value investor, it should matter little if you are buying a stock at all-time highs or lows, or on an upward trend or a downward trend, providing that based upon your calculations and with a margin of safety built in, the stock offers great value. And that is all for today, folks. I do hope you've enjoyed it, and it has aided a little on your journey to becoming the best value investor you can be. Please do consider adding to playlists so that you'll be alerted to future editions. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.